will point out that you saw me flexing maybe with my daughter rock climbing. This song is what she uses to get pumped up before she goes rock climbing, so that's why that was selected. All right, my name is Justin Draplin. I am the founder and CEO of Fortified Solar and Eclipse Financing. I've got about an hour. Feel free to interrupt me as often as possible so I can just answer questions instead of having to do this. All right, so we are a vertically integrated solar manufacturer. So we actually have a manufacturing plant in South Carolina. It's up here, the top right picture. It is 150,000 square feet. We manufacture a BIPV, a building integrated photovoltaic. It's a steel roof that has the solar integrated into the product. Because we are vertically integrated, from manufacturing to development to structuring our tax equity deals, it gives us a lot more flexibility in the way that we structure to make it a little bit more secure, a little bit more audit-proof, and a little bit more reliably installed. So, real quick, how many people in here have done something with solar and tax credits? Okay, a little less than half maybe. Who is working with us currently? Oh, look at that opportunity. I love it. We're better than them. For all of you that didn't raise your hand the second time. But this is the basics of how those solar deals work. Okay, you've got the Inflation Reduction Act passed in 2022, which created these incentives for solar. There's it's technically a 6% base, based on certain requirements. It's a 30. We're going to skip some of the nuance of that, but you basically have a 30% credit, you have a 10% credit to meet domestic content standards, and a 10% credit if it's in an energy community. There are also some other credits, like a low income adder. We're not going to get into those. These are the ones that are easy to get, anybody can get, they're unlimited, there's no cap, you don't have to know somebody in politics to get it. Some of those other ones you actually do. So that's what you use. On top of that, you've got this bonus depreciation. It qualifies for all bonus depreciation. Now you see this little reduction at the end there. You do have 100% bonus depreciation, but you have to reduce your basis by half the credit. So that's where the tax benefits of solar come from. And then there are different ways to structure that. Credits are transferable for a passive investor, but you can actually make them active as well. So you can get all kinds of creativity in here. So this is a simple example of $1 million income. This is not 100% accurate. For the CPAs in the room, don't tell me about, oh, well, it's only 30%, 70% on this much of income. This is for illustration purposes, right? So we got $370,000 in taxes due on that million. If we do a $100,000 cash purchase of a solar project, it generates an $86,500 ITC. This is like a standard structure that we use, so these numbers will be consistent to try to help tell the story a little more cleanly instead of bouncing around. So that one project will create that much tax credit that will reduce that tax due to $283,500. That's just the ITC part. Now we got the bonus depreciation part. You've got the same $100,000 project, $173,000 purchase, less half the ITC. You're taking a deduction of $129,750 in year one. And now we need to add those together to get a return. So this is that first year benefit, and this is like the most compelling argument people have for doing solar. There are very few businesses that you can start that you can get an immediate return. You can do oil and gas, but you're not made whole right away. You're still behind. With a solar project, you can be positive year one. This one is showing approximately 130% ROI. If we take out the ITC from the capital, we got $13,500 cash. Your depreciation is about a 9.4 to 1 on your depreciation portion. That's important because that credit you can look 3 years back. So you can actually pay for that part using previous taxes. There are limitations, talk to your CPA, all that kind of stuff. But this is the general idea of why people are interested in solar. Now you also have some revenue stream that comes from that over the next 5 years. There's a 5-year recapture period. You can hold it for 40 years. You can donate it. You can do all of these other things with it after. But this is kind of that first-year benefit that people really seem to like. And I mean, I get it, right? I'd rather give Justin me $100,000 than give the IRS $130,000, right? This just breaks it down again, all the same numbers. We use that $100,000 cash project to kind of break it down and give you like a 5-year ROI based on your bonus depreciation at the federal level. Your state is going to be, gosh, this is so boring. I mean, it's exciting, right? Because we're saving money, right? Everybody wants to save money, but like, it's so boring. But the people that make a lot of money are going to love it, right? If you're a CPA and you know taxes and you understand what this means, you should be excited, I think. So it's great. What people don't realize, a lot of people don't realize, is this is like a $30 billion a year industry. This isn't some like niche, small, little solar thing that some people do to make some money. The big companies, the Fortune 500 companies, have been doing this for 20 years. They developed the entire industry over the past 20 years with specific structures, the same ITC. The big difference is with the Inflation Reduction Act, they made it a lot bigger and they made it transferable, which gives us a lot more flexibility with how we structure. The other thing it did is give some added benefits to domestic manufacturers. So again, us being vertically integrated, we own our own manufacturing facilities, so we can use a lot of those benefits within our structure. We develop our own projects, so we have control of that project, and then we structure all of the financing ourselves with our financing company. So it's not a conglomerate of different parties. If anything goes wrong, guess who gets blamed? Me. You're welcome. All the food's put away, right? Okay. All right, so active. So this is the big one that brings that dollar amount down, right? So the big corporations, C corporations, they don't really have to deal with passive activity rules. They can just buy credits. They can do tax equity deals. They can take the depreciation. They can take the credit. They don't have to worry about AMT, TMT. They don't have to do all these things. So for them, it is a little bit easier to do. Now, when you get to an individual and you got somebody with like W-2 income, ordinary income, you do have passive activity rules that play in. If it's passive income you're offsetting, you don't have to worry about this. You can skip this. But if you're not, you have to be in the business of solar. Okay? I get it. Solar, it's a great tax mitigation strategy. But you have to start a business. You have to have a solar business. You can't just have this treated as an investment. If the IRS treats it as an investment, you don't get the benefits. You treat it as a business. How do you do that? You meet active material participation rules. The way we structure ours, we recommend single-member LLCs. There's a lower threshold for material participation. It's 100 hours of material participation. We've worked with Cherry Becker and Nelson Mullins as our primary CPA firm and law firm, who put together our memos on material participation, who reviewed some of the materials that we created to meet material participation, and then we built the software to track all that for everybody. So the buyer has access to it, the CPA, the advisor has access to it, we have access to it. Everybody can see whether or not you're in compliance the entire time, whether or not the client is in compliance the entire time. Because like, yeah, you don't have to turn this in with your tax return, but like, just track your time. It's so easy. Just track it. We make it super easy. If you don't meet this, it falls into passive. You don't lose the credit. You don't lose the depreciation, but you can only take it against passive income. You can only take it. You can still use a 3-year look back. You can still carry it forward for 22 years, but it can only be against passive income. Did I hit all that hot stuff? This is the first time I've done this presentation. Can you tell? At risk. I like to talk about this because this is an important aspect of solar deals. So the IRS is going to look at a solar deal, and when you're taking all this depreciation and you're taking these tax credits, are you really at risk? And that's going to apply to, do you have any cash in it? Do you have any skin in the game? Do you have something to lose? That's what it means, right? doesn't matter who you are, you have to meet at-risk rules. Whether it's an individual investor, which had a laser pointer. Is this a laser pointer too? Oh, it is. Look at that. It's a terrible one. Can anybody see that? That would have been helpful. All right. Individuals. Closely held C corporations. So at-risk rules are going to apply to everyone. Doesn't matter who you are, you have to meet these. They're going to affect, it gets worse. They're going to affect your ITC, your tax credits, and your ability to realize that depreciation loss. So if you're not at risk, you don't get those things. You might claim them, but if you don't meet these and you get audited, you lose them, and then you get penalized, and then you pay interest. So you want to meet these, right? There are several ways to meet this. One, pay 100% cash. You know, that the deals we structure, 100,000 cash. There's some debt in there. The safest way to meet at risk is just to pay 100% cash. Great. Why doesn't everybody do that? Well, because they want 130% year one ROI. They don't want a 70% ROI. Totally fine. You can do that. But now you have to make sure your debt meets it, right? Even when you have debt, there are at-risk rules for the debt. You can't do zero down. The IRS is going to flag that immediately. For a qualified financing company, you have to have a minimum of 20% cash in. That's an IRS rule. If you're not doing from a qualified financing company, the minimum is, gosh, we have a qualified financing company, so that's the important one. Just work with us. If you don't, you do seller financing, it's like 25% or 30% minimum cash in, and it has to be a straight line debt. It has to be amortizing, and it has to be a fixed term with fixed payment schedule. If you're not one of these things, you're not at risk. Your debt is not at risk. You don't get the depreciation. You don't get the tax credits. Good luck with the IRS. So you can pledge property. So that's the debt piece. So it's qualified non-recourse. I love bragging about that one because the way a lot of companies do it is they put a personal guarantee on it, right? Which is great unless the company does something bad, because then they're coming after you. So we have qualified non-recourse debt. We don't do any personal guarantees unless it's a unique structure. We don't even worry about that right now. You can also pledge property, right? Put other property up for collateral, including the solar facility. Oh, safe harbors. Who was I talking to earlier? TSOA? About safe harbors earlier? So these credits expire in 27 for solar, unless you safe harbor. They have given very specific ways to safe harbor. The way that it's written is you have to have started construction on a project. Although with the government, start construction means like 10 different things. One of the ways you can meet the start construction requirement is through a safe harbor that is a 5% cash safe harbor, whereas you physically spent 5% of the cash in the project, and then you can put it in service anywhere between now and 2030. I like to say that this is like in school, right? In math, like you got to show your work, right? If you install it before 2030, you don't even have to show your work. You have to show that you collected 5% in 26, 27. You put it in service by the end of 2030. That's all you have to do. You don't have to do anything in between. There's some caveats to that. We can actually go back, we can drag this out all the way to 2035 if we have good reason to. Delays in the project, some specific ones that the IRS gives. If there are delays with the financing availability, which we have a financing company, and there are delays with the custom component manufacturer, which is also our company. So we have unique assets within our umbrella that we can make sure we stay compliant for our client and get them what they need when they need it. Another way that you can start construction is physical work of a significant nature. You can do that off-site, you can do that on-site. On-site is like you have to be putting something in the ground, you have to be putting something on the roof physically. Permits don't count. Grading doesn't count. Buying material doesn't count. It has to be physically being installed. That's physical work of a significant nature on-site. The other one that we get to use that our competitors don't get to use is physical work of a significant nature off-site. And what that is a custom component manufacturer can prove that they've started the manufacturing of that project. You have to be a custom component manufacturer to be able to use that, which we are. So we get to use that safe harbor as well. So we've been actively safe harboring projects since before OB3 passed. The second they started putting out drafts, we were on the phone with Nelson Mullen saying, what do we got to do now? What do we got to do now? What do we got to do now? He was kind enough to not bill us until March of this year. That was nice of him, though. So we were able to do all this stuff. We got a pipeline of projects. We're helping our current clients safe harbor right now because we have like another 10 days to do it. So like that's why I'm not spending a lot of time in here. I'm literally helping set up more safe harbors for clients. Literally like up until I walked in here to do this call, right? So that locks in all the benefits. So we do a safe harbor today. We've locked in that benefit through 2030 and possibly beyond. Why is that important? Because a client that does a contract with us today before July 4th, we can structure that master contract in a way where the project they do this year meets their 5% test. And then they can contract within the same contract for the remainder. There's no additional cash due. 100% of their cash just applies to their year one project, so it's not like they have cash sitting out there for the next 5 years. They basically reserve the right to those projects that we assign to them. A lot of people in solar aren't doing this. Quite frankly, a lot of people in solar have no idea how to do this. They're called our competitors for now. All right, due diligence. So this is some stuff that we've done. I was talking to some tax advisors earlier, and a little bit tongue-in-cheek, like, you can get a memo from anybody to say anything that you want, right? Which is fair. We do work with well-known CPA firms and law firms. Nelson Mullins will write your client their own memo if you want. That way they're protected. They're not cheap. You're talking like 20, 30 grand. So your smaller buyers probably are going to just take a pass and risk it. Your bigger buyers, we have buyers that are spending 5, 8, 10 million cash. You want your own legal opinion to make sure you're protected against any of the potential recourse? We can get that done for you. An hour. That's it.
Got a question right here, Justin.
Okay.
Was that an hour? That was not. That was like 20 minutes. Nailed it. Sure.
Number 2, Tom.
Yes, it is. Okay. Okay.
Correct. I know I was interrupting myself, but thank you. So the question was, if you're building a building and you want to safe harbor a project, can you count the 5% just towards the solar, or does it have to be towards the whole building? Ish. So it's really just the solar. So you could be doing a $100 million project and your solar is $1 million, you have to be 5% of the million. And then you can place that in service over the next however long. He's got a microphone.
Thank you. A question I have is on the material participation requirement. There's a company that we've used that has a program where they invite the investors for a two-day training, whatever it is, session, due diligence session and stuff like that. So if a couple goes, they basically have almost met the material participation requirement for 100 hours. Is that one of the things, because I think I observed that you mentioned that you've got, some written material that people have to use. They have that too, so I'm curious about that.
Yeah, so the question was, there is another solar competitor of ours, presumably, that is inviting people to a 2-day event, seminar, learning session to try to meet the material participation requirement. Right? Does that meet it, is the question.
Do you offer that too?
I'm sorry?
Do you offer that? You also offer that?
So we don't care, if you want to come visit our manufacturing line in South Carolina, we'll give you a tour. You can set up in our conference room and you can work from there for as long as you want. We'll give you all kinds of stuff to do. Okay?
So that will qualify then for the material participation?
Without knowing the content and without knowing what's being taught and the purpose behind it, I don't want to answer specifically to that. Like, I'm not going to say like yes or no without knowing a little bit more. If you're leaning on a 2-day seminar for 100% of your material participation requirement,
Well, that's not what I said. Okay.
I hear what you're saying. You can do educational things if it's for the sake of solar business. Like there are things like that do meet it. What I'm just saying is I don't know like the materials and what's actually being done in that seminar. Like if I just say, hey, come hang out for 2 days and we'll call it a solar seminar, that doesn't count. If you're actually doing stuff like researching product, right? So like you're a solar business operator, right? If you're spending 5 hours researching our building integrated photovoltaic, what's the energy output of it? What's the degradation factor of the cells compared to another panel made by LG or something like that? That would be time that would count.
Okay.
It's going to be about what's the content, right?
Second thing I have a question about is, I am very persuaded by the case you've made and everything you've articulated. One concern that I have is, it looks like the vertical integration, the horizontal integration, everything is being done by you and you and you. Help me basically understand that risk from a participation or an involvement with you standpoint.
Okay, so the question is, we are vertically integrated. What is the risk profile of our company compared to our competitors?
Yeah, you're doing everything, basically, soup to nuts, I care.
Yeah, right. You get to blame us, which is great because I don't use competitors' names as much as I want to. But we have competitors that have been forced to wire us money because they can't perform. And their clients were so pissed off, we got wires on December 30th. And they moved into one of our projects because they couldn't perform. And guess what? That client is still with us and does not use our competitor anymore. The risk is if we go out of business. That's your risk. Okay, but now let's look at a traditional solar developer who doesn't own their manufacturing and isn't developing their own projects, and now they come in. Well, now you have triple the risk. Because if any one of those go out of business, the whole deal falls apart. So I would argue we definitely reduced the risk on that. When you talk about the electrical contractor and getting a permit, right? You talk about the control of the site. Who has the control? Is it still the original person? You talk about access to materials to install in time to make sure you meet your deadlines. That's all on us. So that's your risk. Do you believe that we're going to execute? We've yet to miss a deadline. I'm not saying we're never going to miss one. I'm not saying we're going to, I give zero guarantees. That's the other thing. At risk, you cannot guarantee anything. We have a competitor that literally put guaranteed results. It's still on their website. That alone would be enough for the IRS to go and say, you weren't at risk. I don't care that you have a personal guarantee. The client you bought from literally has on their website, they're promoting you a guaranteed return. You're not at risk. There goes your credit. There goes your depreciation. By the way, here's your penalties and here's your interest. Like, it's crazy. Sorry. Soapbox. So talking about the risks in solar, the biggest risk is recapture. Once it's installed, placed in service, and you generated the credit, you generated the depreciation, your risk really comes down to that next 5-year window. Now what happens? We're still involved in the project. A lot of our competitors, it's like a bait and switch. As quick as I can. I just bought this project from this person. I'm going to triple the price and sell it to you as quickly as I can because of the tax benefits. They've made their money, they walk away. We're still in it. Our financing company is still in it with you. We have a vested interest in the long-term success of the project because we manufacture the product going into it as well as have the financing at the end. Like, we're not going anywhere. Our competitors, should I tell them? Should I tell them the questions to ask? Ask your competitors if they've ever been disbarred from their law firm. Please ask them. I'm not allowed to say who it is because I signed an agreement that I wouldn't. Please ask them. Ask my competitors, how many of you are currently under investigation for fraud? Please ask them. I can't say who it is. It's public record that we can Google this stuff. Now ask me. No. So I feel very good about our positioning and the way that we've structured our company to protect not only ourselves but the client with things like qualified non-recourse debt. With being, we're actually building a company. We're not just trying to quickly sell something and move it and move on. Like, we're actually building a company. And I think that that speaks throughout the way that we structure our things. We want the client to be happy. We want the advisor taken care of because we want to build something that's everlasting.
Yes. My question comes back to the original proposal that you were showing us.
It has backwards.
Awesome. So if I'm understanding this correctly, instead of putting, let's say they owed $200,000 in taxable, or I guess they have $1 million in taxable income, they're taking $100,000 of the $370,000 that they would owe and putting it into the solar business. Is that correct?
Correct.
Okay. And this will, if you go to the next slide, it'll generate $130,000.
That's the amount of depreciation. So this is your tax credit. So you get an $86,500 tax credit. So the first thing you do, actually, we should probably switch these. You take the depreciation first, but this is just taking the tax credit into account. So you've reduced your taxes by $86,500. The $130,000, that's a deduction. So your credit is a cash value.
Sure.
Your depreciation is a reduction. So that is going to come, that $129,750 is going to come off, oh, I went the wrong way. That's going to come off your million.
Right.
Which is going to have another reduction in your taxes.
Okay.
So the net ends up year one being about 130%. Give or take, depends on your state, whether your state has bonus depreciation, high tax, low tax, no taxes.
So around 130% ROI.
Year one, yeah.
Okay. And then can you share just a little bit more on the year 1 to 5, like the income that the business itself is generating?
Yeah.
I guess in this type of example.
Yeah, so it's generally pretty minimal in the first couple years. It's got an escalator in it, goes up about 3% per year for the next 40 years. So it starts off really low. We actually used to do like a few percent, but the reality is like the buyers all wanted more, right? Like, you guys are all in tax mitigation. Can I reduce more taxes, right? So it's down to like 0.5% year one, but then it increases as time goes on. And that was, honestly, that was just because of the demand of the buyers. Like, they wanted as much leverage as they could get out of it. So which increases your year one ROI, right? So it goes up about 3% per year. The other thing I'll point out compared to our competitors, because we're building integrated photovoltaic, or a steel roof, and we combine ours in the self-storage space, because self-storage uses a lot of steel roof. It's glorious. So what we do is we enter into revenue sharing agreements with self-storage facilities that are re-roofing with our product. What that means is the benefits of the self-storage facility are tied to the solar and vice versa. So suddenly our asset becomes an appreciating asset. Self-storage is a top-performing commercial real estate asset class in the last 30 years. So our asset, because of the way we structure them, we actually have it modeled as an increasing value, versus our competitors are immediately decreasing, because it's just solar. Well, we're actually participating in the revenue share with the self-storage facility. So that channeling that revenue goes up, and not only that, the value of your product is going up. So what does that mean? So yeah, there's a little bit of cash, but if you're actually increasing your asset value over time, you have an added benefit to our product that our competitors don't have, because of the way that they're structured and all the things, right? So we model it, we generally estimate approximately a 10% increase in value of the asset over 5 years. Could be more, could be less. These are modeled based on wherever that project is, what's happening within the self-storage space, what our energy values at. We actually do a whole pro forma, we do a credit approval memorandum on the site, we do a full underwriting and provide that to the buyer.
Real quick, so that's an actual sellable asset in year 5 or further, where they could sell those solar panels and actually get a return on capital other than their initial investment back?
Absolutely. Yep. Because if the self-storage operator wants to own it, they want it. So they're going to be your first buyer. We'd be the backup buyer because we have the financing on it. Well, we have a lot of clients wanting to do those donated. Again, they are very interested in tax deduction. So solar, the way that we do ours is a building integrated photovoltaic. When you go to recapture, it's treated as 1250 property. I think I'm using the right terms. CPAs, 1250 is the better one. That one. So because of that, there's a max on the, if there's debt when it's donated, your maximum interest rate on the recapture is 25%. But additionally, because you're outside of the straight line depreciation period, you get an additional deduction of the delta between what that third-party valuation is and what's left on the debt. So let's just say there's 40% left on the debt, your value went up to 110%, you get to take an additional deduction of that delta. You recapture 25% on the debt piece that's donated, but you get an additional deduction that's way more than that on the top end. So that's what a lot of people are planning to do, which that isn't even, in the ROI in here, that's not even taken into account. And that's going to be all on a client-by-client position. You got limitations on the donation deductions, and that's for the tax advisor to figure out what's the best strategy for them to exit it. They can just hold it for 40 years if they want.
Does the charity just take over the solar panels, or the revenue?
Correct.
Okay.
All of it. So they would take the asset and the debt.
So I have a couple questions. So we like the strategy. We've
Who's talking?
right here.
Oh.
Right here. Yeah. So we got a couple cases we're working on with you guys. Our tax team was doing a pretty deep dive into the qualified non-recourse debt. We thought that was a pretty cool, aspect of what you guys are doing. But the question that came up, and we were doing research, so I could be misremembering, some of the facts. But my understanding with the qualified non-recourse debt is it has to be related to real estate activities, is what I read. And so I'm wondering, how do we, if it's classified as a real estate activity, how are we not limited to the passive, activity rules of real estate of 750 hours? So maybe, like I said, that was just one question I had. I didn't know.
Yeah, it's a little more nuanced. It actually has to do with real property,
Gotcha.
not real estate
Okay,
business.
gotcha.
And because we're building integrated photovoltaic, which is a structural roofing component as well as solar, that's where we can kind of backdoor into being treated as an asset of real property as part of the building.
Gotcha. Okay. And then my second question is, if we have clients coming in, I understand the safe harbor sort of, but if we have clients that come in after July 4th, is there still an opportunity for them to do this? If so, what is that? Is it it's mentioning some kind of limitation after the 4th? So What does that look like? If people come in August or?
So July 4th, again, is the safe harbor period. I keep forgetting to repeat the questions. It's just, I feel like it's wasting time. Thank you. And then I mumble and waste more time that way. What was the question?
If we have clients that
Safe harbor.
hit the
Yes,
deadline, yeah.
So if you don't meet the deadline, you can do projects as long as they're placed in service before December 31st of 2027. You don't need a safe harbor, you just put it in service and you're done. What happens after July 4th is you can't put anything in service that starts after that date and put it in service after December 31st of 2027. So put another way, starting a contract with us before July 4th reserves the option to do projects with us for the next 5+ years. Doesn't mean you have to.
So otherwise, you're just limited to next year and a half.
Correct. Or unless you get the safe harbor from somebody else, because safe harbors are transferable.
Oh, okay.
So like somebody that has a safe harbor that isn't going to use it can actually sell that to somebody else. So we have advisors right now that we're talking about like doing these large safe harbors for them because they know that everybody's getting addicted to solar right now and not many people are safe harboring. Like of all of these wonderful hands that did solar that didn't use us yet, how many of your solar vendors have talked to them about safe harboring projects through 2030? One. You're welcome. Everybody else? So we have a big pipeline of safe harbor projects. So even if your clients don't, even if you don't, we'll have access because of the way that we're working with our other advisors that, if advisor's not using it, we're all incentivized to create safe harbors and sell those safe harbors.
So you're saying if somebody commits to you before the 4th, $50,000 is good with you for the next 5 years?
So a $50,000 investment would safe harbor to $1 million in projects over the next 5 years.
Okay, so based on what he puts in as a deposit, determines the potential solar projects he has over 5 years.
Correct. It's based on 5%. So whatever cash is in before that, and it can be debt as well. Not to go too far down the rabbit hole, we have a financing company. So if somebody's in a real hurry, they need us to loan them the 5% at AFR to meet the deadline more quickly because they don't have the cash, we'll do that. Do my competitors do that? Absolutely. Yeah, because they're buying our panels, right? And we have a vested interest in ensuring that project gets placed in service. We don't care who does it. We just want it to happen. Yeah.
So I'm sure that this is covered in your activity letter, but just out of curiosity for the financing company, is there any concern about arm's length if y'all are owners of the financing company?
Yeah, so we set this up several years ago. It is a qualified financing company. You're right, we do have a memo. You can get anything memos. You can run it through Claude, and Claude will say, yes, they're good. So we have a memo that kind of explicitly calls that out as why we're still a qualified financing company. It is set up as a separate entity. It is in the business specifically of financing solar, so it meets the requirements of the IRS in the at-risk memo. I think it's called the at-risk. What am I clicking at? Want to do the countdown again? That's fine. There it is. That at-risk memo is the one that's going to spell that out because that debt is important that it's at risk. Even though it's qualified non-recourse, it still has to meet at-risk rules to capture that depreciation and that credit. So that's going to be the one that kind of breaks that down in more detail. Yeah.
I'll go to Mike.
4th of July is right around the corner.
Man,
In case anybody hasn't been looking.
Elite is the one that picked this date, okay? I would have had this event in January.
So my question is,
I'm just kidding, Elite.
I invest $250,000.
Cash?
Yes.
Okay?
Am I allowed, or what is the consequence of selling $50,000 units to clients down the road to preserve this opportunity for them?
Well, 250,000 cash by July 4th would actually reserve, what's 250,000 times 20? So you're actually reserving 5 million worth of projects to sell to your clients. Yep. And so the risk is going to be that 250,000 cash. So the way most people are doing it is they're applying 100% of that cash to their year one project. So now you've used the cash, it's not sitting anywhere, your risk is pretty well mitigated, and now your contract has you be...
Was it something I said?
Oh, thank you, look at that. Appreciate you. It's just a clicker too, it doesn't actually provide any value. So once you've applied that 250,000 cash in your year one deal, you've used your cash, you've gotten all your benefit from that cash, and now you have another 4 million of safe harbor available. So that's what you now have for your clients. Well, the beauty is 2028 comes around and you have access to new clients that don't know about solar, and you can be like, oh, guess what? I've got these $4 million of solar credit safe harbor, and I know your competitor didn't do this, so now you can come to me, and I've got your solar deal. Sorry, competitor people.
That was the intent.
I got you. We'll steal all our clients.
That's legal.
No, we're not in that business. We're not in that business.
That's a legal thing to do, to be able to reserve it and offer it to your client.
Yes, Google it. Or ChatGPT it, as the young kids say these days. I don't know what they say these days. But yeah, so those safe harbors are written into the law. Even OB3, we actually have a post-OB3 I2C memo that kind of breaks that down. FIAC, we're missing one. Oh, we have a safe harbor memo, believe it or not. Oh yeah, safe harbor compliance and ITC. Yep. Correct. So you're going to be sending your clients to that guy right there.
Need to repeat the question. So after December 31st, 2027, solar projects like this cannot happen unless you have safe harbor that up until July 4th.
Correct.
So really the whole solar industry will change drastically after that unless Congress
it's
changes.
it's already changing drastically. I mean, you probably didn't see, but a good group of people that had their hands up when I said who's work with solar but not us. Only one of them had their hand up and they talked about safe harbor. All of those competitors aren't doing this. They're gone. Unless they can find somebody that's safe harbor and buy that project, which we ain't selling for that.
Was it solar panels only, or like solar battery or battery storage?
Solar. All solar.
Okay. Thank you.
Like 15 minutes left, guys.
5 minutes.
I have a question about the 3-year look back. So, for our clients that owe, $200,000 or more for the last couple of years of unpaid taxes, is this a good strategy for that?
I'm so biased. I have to say yes.
How does it work?
Yeah, I mean, we really defer. We don't do tax returns, right? Like most tax preparers have software and they can plug in numbers and do magical things. Most of our clients do use the look back because it just gives them a much higher IRR, right? They're paying for this year's tax mitigation at a 9.4 depreciation to 1. If they can use the credits in previous years, it's just that with non-recourse debt. And a key piece of that is you don't actually have to amend the return. You can do a 40. Who said it? 1045. You can just request a refund without having to actually amend the return if you want. I don't care. We don't do it. But many are doing that to get a faster refund.
I haven't done solar before, so
this is very basic, but I'm just trying to understand. So let's say a client buys panels. Is that what they're buying? And I'm assuming they create an LLC. They buy panels depending on the amount of deduction they need. Where do the panels go? And then are they getting some kind of lease payment during the life? And
Yeah.
is there a percentage that they get? How does that work?
Yeah, so they're buying the solar facility. The solar facility is going to include solar panels, it's going to include an inverter, an operating solar system. So the key to generate the credit is you have to be able to use energy from the facility as intended. So it's everything that would be included in generating that power. So that's what they would own. So for the sake of our projects, the BIPV, building integrated photovoltaic, so they actually own the roof of a facility and enter into an agreement with that storage operator. We structure it, it's an energy services agreement structured as a revenue sharing agreement. So what happens is they share the revenue from the storage facility and the solar. Solar operates their business, storage operates their business. They share revenue from that. So we model out the cash flows from that. Our financing company acts as the paying agent. So the storage facility operator will make their payment to our facility, to our financing company. We'll do quarterly reports and send quarterly payments based on paying down the debt first, and then issuing that check to the client with a quarterly statement.
And the 100-hour rule, if you're talking material participation, you said some of it could be education. Define what the other hours should be or could be that meet the 100-hour test.
Yeah, so we have, if you go in our software, we have like a whole list of stuff. The key is, like, there's so much nuance in this, it's hilarious, right? Reviewing financials, qualified or not qualified? The answer is depends. Why are you reviewing them? Are you reviewing financials for the sake of what's your return on your investment? Not qualified. Are you reviewing financials for the sake of a business decision? Qualified. So what we've done is we've created a book of stuff like that we've had reviewed by Nelson Mullins that's worded in the right way, because that's part of it, right? Like, it's just wording it the right way, right? If you say, hey, I reviewed my investment, don't put that. I reviewed my business activities of my solar business. Oh, good. You can do that. So there's some nuance with that, right? But that's why it's important to work with the CPA, read the memos. We have a passive activity memo from Terry Becker that kind of spells out what's qualified, what's not qualified. We have our own. I always like to talk about sales and marketing. So, like, it's good for all of us, right? Because then your clients can go and sell solar to somebody else. If they get a commission, now they have another revenue stream, and also sales and marketing of a product is 100% going to be material participation. Nobody's going to argue with that. You're selling a BIPV. And then I get a sales team, which is great. Everybody wins. How would it be? Correct. Such a short one. We can get one more, right?
What's the viability of this industry beyond the credits or in the absence of the credits? One follow-up would be, what's your vision of what happens if it's not viable, absence of the credits? And then what's the vision of your company beyond the...
See what he did there? Last question, 3 parts. I love it. You're going to have to start over, though. What was the first part?
What's your vision of the viability of this industry, absence of the credits?
100% viable. Solar is going to be around. Fossil fuels are limited. Solar is a proven model. The costs are coming down. Our product, people are like, well, how much is your product? I say, a lot. We have the most expensive solar product in the market. Why? Because we can. Okay? The reality is we could charge less. And we could actually sell this at a point where the roof, the entire structural roof that we're manufacturing pays for itself just from the electricity at today's rates. rates are only going up with AI, all that stuff. As energy goes up, solar becomes even more viable. Part two of your question. So, like a whole lot. Oh, he's trying to sneak one in. What? I think the reality is it's going to be a Democratic administration when it comes to solar. Within the industry, they call it the solar coaster for a reason. It just does that. That's what it does. This is a mic I